In recent developments, Canada made headlines with a sudden shift in policy, withdrawing its proposed 3% digital services tax on major U.S. tech giants, including Amazon, Google, Meta, and Apple. This tax, initially meant to apply retroactively to 2022 revenues, was intended as a domestic revenue measure. However, after U.S. President Donald Trump publicly criticized it as a targeted attack on American companies, Ottawa scrapped the levy mere hours before implementation. This 11th-hour decision prompted U.S. officials to agree to restart stalled trade negotiations and lifted the immediate threat of retaliatory tariffs on Canadian goods. The reversal caught widespread attention and revealed how deeply Canada's economic decisions are intertwined with U.S. political pressures. While this digital tax drama dominated the headlines, a more transformative development in Canada's energy sector quietly unfolded. For the first time, the country exported its own liquefied natural gas, LNG, with the inaugural shipment departing for Asia, marking a significant departure from its traditional reliance on cross-border pipelines to the United States. LNG is natural gas, mostly methane, that has been cooled to approximately -162 degrees Celsius, converting it into a liquid. In this liquid form, the gas occupies just 1/600th of its gaseous volume, making it far more practical for long-distance transport and storage. Once delivered to its destination, LNG is regasified and distributed through local networks for heating, power generation, or industrial uses. This form of energy has become increasingly vital as it enables countries lacking pipeline infrastructure to access global gas supplies. Prior to LNG, natural gas trade was restricted to nations connected via pipelines, which left many without access to cleaner-burning alternatives. LNG's flexibility allows for transoceanic delivery, expanding energy options for buyers and increasing resilience in the global energy market. It also allows importers to diversify suppliers, thereby minimizing dependence on any single source or vulnerable trade route. At the core of this advancement is Shell's LNG Canada project, which has reached a significant milestone with its first export cargo successfully loaded. The vessel Gaslog Glasgow departed from Kitimat, British Columbia on June 30th, carrying the shipment to Asian markets. Shell holds a 40% stake in Canada's first large-scale LNG export terminal. The timing is critical, as demand in Asia for cleaner-burning fuels continues to rise, with buyers actively seeking alternatives that bypass volatile regions such as the Middle East. The Kitimat terminal's location on the Pacific coast offers a substantial logistical advantage over U.S. Gulf Coast facilities. It eliminates the need to pass through the Panama Canal, reducing shipping time and costs to East Asia. This not only improves the commercial competitiveness of Canadian LNG, but also enhances supply security for importing nations. This move represents a pivotal change in Canada's gas export strategy. In 2024, Canada delivered an average of 8.8 billion cubic feet of natural gas per day to the U.S., amounting to around 3.2 trillion cubic feet annually, and generating roughly $8 billion Canadian dollars in revenue. These exports were heavily reliant on pipeline infrastructure linking Canada and the U.S., leaving Canada vulnerable to shifts in American policy and market fluctuations. Now, with the LNG Canada facility offering an alternative route, that dynamic is shifting. With a projected total liquefaction capacity of 14 million tons per year, the terminal will be able to process around 1.9 billion cubic feet of gas per day. At prevailing Asian spot market prices, this could result in an additional $8 billion Canadian dollars in revenue once both trains are operational. By redirecting nearly 20% of its daily output to Pacific-bound LNG shipments, Canada is diversifying its export portfolio while reducing dependency on U.S. markets. This development not only provides a buffer against U.S. policy volatility, but also opens lucrative access to countries such as Japan and South Korea, thereby strengthening Canada's negotiating position in global trade. Moreover, it helps stabilize revenue flows in times of North American price swings. The LNG Canada project was officially approved in October 2018, backed by a consortium of global energy giants: Shell, Malaysia's Petronas, China's PetroChina, Japan's Mitsubishi Corporation, and South Korea's KOGAS. This $40 billion Canadian dollar investment took over 5 years to come to fruition. The facility began production on June 22nd, starting with its first liquefaction train, which has a capacity of 6.5 million tons annually. Initial operations are proceeding at reduced capacity due to commissioning protocols, but expansion is already underway. The first LNG cargo was loaded after all cooling and commissioning procedures were completed, with the Gaslog Glasgow arriving at the terminal on June 29. A second processing train is expected to go online later this year, pushing the total nameplate capacity to 14 million tons annually by 2026. Once operating at full scale, LNG Canada will position the country as the 8th largest LNG exporter globally, trailing just behind Nigeria. This will mark a significant evolution in Canada's gas export framework, which has until now been predominantly reliant on the US. At an average daily export volume of 8.6 billion cubic feet in 2024, Canada is set to expand both its market reach and its resilience to geopolitical tensions. Beyond the economic and strategic advantages, local collaboration has been central to the project's development. LNG Canada has engaged closely with Indigenous communities and regional stakeholders. The Haisla Nation, whose traditional territory includes the terminal site, secured contracts like the $500 million low-emission tugboat agreement, ensuring meaningful economic benefits for the community. This partnership-based approach helped ensure the project's social license. During peak construction, the site employed nearly 9,000 workers, and over 5.8 billion Canadian dollars in contracts were awarded to British Columbia-based businesses and First Nations. This underscores the project's significant economic impact at the provincial level. From an investor's standpoint, LNG Canada is a cornerstone of Shell's long-term global LNG strategy. The company anticipates a 60% rise in global LNG demand by 2040, primarily driven by Asia. Shell's integrated gas division currently handles around 66 million tons of LNG sales annually and controls roughly 10% of the global LNG fleet. The company expects this business line to grow at a compound annual rate of 4 to 5% through the decade. Shell aims to add 12 million tons per year of new LNG production capacity before 2030 via new projects and international partnerships. Discussions are ongoing among the LNG Canada consortium members about a second expansion phase, which would add 2 more liquefaction trains and double the facility's capacity to 26 million tons per year. A final investment decision on this expansion is expected next year, signaling confidence in the long-term demand outlook and in Canada's ability to deliver competitively priced, lower-emission gas. Thanks to its strategic geography, strong infrastructure, and collaborative stakeholder model, LNG Canada is well-positioned to reshape the dynamics of global LNG trade. It provides a new, secure supply route for Asia-Pacific buyers and establishes Canada as a formidable player in the international energy market. Thank you for watching. As an independent channel, we don't receive corporate backing and rely on your support to continue producing quality content. If you found this video informative, please like and comment below. It helps our work reach more people. We appreciate your time and community support. Don't forget to check out the next video we've selected for you. It's right on your screen.